Hey, good afternoon, everyone. Thank you so much for giving me your time. I hope to provide you with a whole new outlook on a way to trade options, and to walk you down a completely different path than you've ever been taught in the past. And before I get into the webinar, let me just give you a little bit of information about myself. I'm a graduate of the University of Pennsylvania and former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. Began trading futures and Forex markets about 10 years ago, and I've been trading options for about 15 years. And I'm involved in the optimization of software systems for the last 10 years, and that's where the software that we use to trade futures and Forex come from this optimization process. Now, if you're like me, and a lot of people walk the same path that I walked 15 years ago, the first thing that you do when you trade options is that you try to trade them on your own, and you lose money. And then the next thing that you do is you subscribe, and the amount of money that you lose when you trade options on your own is probably pretty minimal, because you don't really trust yourself, and your trading is very tentative, and you're brand new to trading options. So the next step is usually to subscribe to an option service and take trades that are recommended by the options guru, and you wind up still losing money. And then the most expensive option that a lot of people ultimately take is they hire an expensive mentor, and his fee is extremely high, and his trade recommendations cost you a fortune. And we've had a lot of people come here for mentorship, and they've already lost between $70,000 and $100,000 trading options. Now, if this is the path that you've taken, I can guarantee you that you have come to the right place. Now, 70% of options traders consistently lose money. That's a well-documented metric. 30% of options traders consistently make money. And the promise that I make to you in this webinar is that I'm going to start you down the path to reverse this money flow. I mean, why can't the losers give their money to you? I mean, why can't they pay your bills? Why can't they pay your mortgage? Why can't the 30% of options traders, the 70% that consistently lose money, be the ones that make you financially secure? There's no reason why you can't be among that 30%. And if you give me the opportunity to show you how to trade options and stay here until the end, I'm gonna provide you with a special bonus, as well as giving you the nuts and bolts of how to trade options profitably. Now, this is the most dangerous book ever published. It's Trading Options for Dummies, because it emphasizes the same thing that many mentorship programs emphasize, and that is the two components of trading options. The first are the Greeks. And you're going to see that although understanding the Greeks are important, they make up an ancillary and tangential component of taking a successful options trade. And you're also going to see that this book and most options webinars or seminars, long seminars, also emphasize the mechanics of taking a very complex option strategy, an iron condor, a butterfly, and the multitude of others that are out there. And you're going to see that that's also simply a very tangential and peripheral component to trading options profitably. They don't really matter at the point that we are in right now. And those are the things that are going to come really easy for you once you get a core trading methodology that works for you. So this is a very dangerous book because essentially all it does is teach you all the different option strategies, the vertical spreads, the horizontal spreads, and all the different more complex strategies that we just mentioned. It goes into the Greeks, but doesn't really give you the nuts and bolts of how to get a successful options trade. So if you read this from cover to cover and really study it thoroughly, you may get the feeling that you understand what you're doing. But what you really, the problem is that really what it does is it deflects you from understanding what's really important. Now, as I said, this book gives great weight to the Greeks and the spread positions, vertical, horizontal, butterfly, iron, condor. Again, you're going to see this is extremely tangential to what we are talking about. Now, what you're going to learn is how to find the best stocks that lend themselves to the creation of successful options positions, and what stocks to avoid at all costs when creating options positions. There are red flags that I'm going to show you that are going to allow you to avoid taking positions in certain stocks. And then we're going to see what the role of the Greeks in spread configurations are. And the fourth and very important component is that of risk management. Now, this is what I call the career ender of most option traders. What ends the career of most options traders? You go to a chart, and the platform confirms, whatever sophisticated trading platform that you're using, that you're in a bullish trend or you're in a bearish trend. And there's no doubt about the fact that the stock is moving up. Now, if it was just as simple as that, and you bought a call, you're going to make money. The problem is that stocks do two things that destroy options traders. The first is they go into consolidation. Now, this consolidation period is where the power of the bulls and the power of the bears are equal. And you can see what happens in a period of consolidation is it traps buyers and sellers inside the channel. Now, consolidation almost always breaks out in the direction of the trend. So if you're holding a stock, the period of consolidation is not a concern. But if you're holding a time-sensitive instrument like an option, it's a tremendous concern because this consolidation channel can last days, weeks, or even months before the stock breaks out in the direction that you want it to. And like I said, stocks, anything that goes into consolidation is most likely to break out in the direction of the trend. The other options career ender is the retracement. And any stock in bull mode can retrace back to support. And that retracement time can take place over hours, days, weeks, or months. It can be a very slow and painful retracement back to support. Now, we're going to assume for the moment that the uptrend remains intact and support holds. To the downside will be resistance holds, and then the stock resumes its move to the upside. But if you're holding, again, a time-sensitive instrument, you're going to wind up losing almost 100% of the premium, of the options premium. So these are the things that you have to avoid: consolidation and a retracement. And you have to enter options trades that in one way or another have a high probability of not consolidating or not retracing. That's the goal. And this is the hurdle to overcome. And this is the first point that few programs make. And these really are the two options killers. Now, I really believe that the market, the forward-looking market, looks very, very bullish. And the reason is this. The market hates uncertainty, and the election's over. And I don't think it matters who won. The fact is that the uncertainty is at an end. And you can see right now the market is making a very strong run to the upside. Now, the Trump administration is going to really insanely cut corporate tax rates, which is going to return a lot more money to businesses. And they're also going to work to repatriate the trillions of dollars of money that are overseas. He also wants to build our defenses. He also wants to build up the Army. So there's going to be a lot of amount of money going to defense. And that's going to pump up. I put the old term military-industrial complex, but the fact is stocks like Boeing and Raytheon are going to benefit tremendously from this money. And big pension funds are going to line up their investments for the beginning of the new year. They start the new fiscal year, they start over. They want to provide a nice return on your investment. In addition, Trump is going to look to spend a huge amount of money on infrastructure. That's also going to go back into companies, which is going to increase revenue. And he's really going to gut a lot of business regulations, which ultimately lead to cost. I mean, it's a lot of money to adhere to Dodd-Frank and all the other business regulations that have been placed on small businesses by the Democrat administrations. So I believe that the market is really going to go into a bull mode. A lot of people are thinking that the bull market is over, but I think the bull market is just beginning. And I'll tell you something else that I didn't put on the slide. We're going to slowly be raising interest rates, but the European Union is going to be doing quantitative easing, basically from our perspective now forever. So they are going to be pouring money into their economy via quantitative easing while we end quantitative easing and slowly start to increase taxes. I'm sorry, to increase interest rates. That's really going to pump up the value of the dollar. And the dollar is going to become a very, very important currency. And the dollar right now is really running to the upside. That's another thing that's going to help the economy. Now, I would like you in your own head, I'm not going to look, but I want you to think and to yourself and decide which is a more important component of trading options. Is it technical analysis or is it fundamental analysis? And I'm going to give you a second to think about it. And okay, you have your time. And here's what you have to understand. Technical analysis, as I mentioned before, is going to confirm that you're in a bull mode, you're in bull mode or bear mode. It cannot guarantee that you're not going to take a retracement or you're not going to go into consolidation. Fundamental analysis in trading options is really of incredible value. And you may not believe it, but it really isn't earnings that's an important component of fundamental analysis. It's two things. It's forward guidance. If you look at Facebook, and I'm going to show you more about Facebook later, they had stellar earnings, but their forward guidance for 2017 was very muted. And the stock took a beating despite the fact that it had tremendous earnings. It shakes the weak hands out of the stock, and the stock collapsed 10 points. So forward guidance is a very, very important key to fundamental analysis. And then I'm going to show you components of fundamental analysis that I don't believe you've ever been exposed to before. Now, I call these my stock catalysts that ensure trend continuation. In other words, we don't want to enter a stock until somebody else has done it right before us. That's not a commercial trader like we are, but a large institutional trader has made a very big bet on the stock. Now, all of these are not equal, and we're not going to weight them just yet, but I want to show you what they are. because this is part of the fundamental path towards trading options successfully. The first is that an insider buys a very large position in the company. I like it to be either the CEO or the CFO. Now, you know, if they're making a $5 or $10 million purchase in their own stock, that they are taking a very bullish stance, and they may know something that you do not know. I mean, they're not going to take, they have this money sitting in the bank, they're not going to commit it to a stock unless they believe that stock is going to ramp up, and it's going to ramp up now, not yesterday. The most important are huge options trades that cross, and all of these can be tracked with certain data feeds. That is extremely important, and I'm going to show you. Now, I want you to understand something that's really key. Let's say you have an insider purchase, or somebody who's sitting with $2 or $3 million to invest in a company. If he decides he wants to purchase 10,000 shares of the company, that's a bullish, obviously a very bullish move. But let's say instead of devoting his money to increase his stock holdings, he decides to buy 20,000 options on the stock that he holds. Now he's not only making a statement that he believes that the company he's associated with is in bull mode, but he believes it's going to go up right now, because when they make these big purchases, the strike price and the expiration date are published in the data feed. So you know, like today, there was a huge call purchase on one of the stocks on my watch list, and it was on PayPal. And PayPal, I'm just taking a look at my watch list here. I'm going to go over this more. 2,500 calls crossed the ticker at an ask of $25, and they're the December 16, 43 calls. Now, that person could have made that investment in PayPal stock, but instead he's making that investment in PayPal options. So he's creating a position, and he feels very certain that PayPal is going to hit his strike price in the time allotted. This is the most important stock catalyst. Now, obviously, brokerage upgrades and downgrades are also important, but again, they're not as key as huge options trades. Now, news, and I put in parentheses esoteric, can really be a huge move, create huge options moves. And to give you an example, the election of Trump, you're going to see that that led to massive shifts in equity. Infrastructure stocks went flying, and a lot of defense stocks went flying. And underlying options just skyrocketed. So depending upon what the news is, I can give you another example. There are many, many examples. When Hurricane Matthew was moving past Florida and going up the eastern seaboard, there's a stock called GNRC, and they sell portable electric motors to power your house, and people use them primarily during, obviously a power outage, and people were buying these generators like crazy. So GNRC, on the news that a hurricane was going to come, went blowing up. Went really moved hard. And I'll give you one that we got in the portfolio. I read in the New York Times, which I hardly ever read, but I read it online, and they publish some good stuff, that we were running out of cruise missiles in the Middle East. So what I did was I went online and found out what company makes them, and the company is Raytheon. So I recommended in the portfolio to buy calls on Raytheon. In a really short period of time, we made 205% on those calls. And that was solely based on this news. And what this news is really fundamental analysis, because fundamental analysis is not only a company's earnings, but it's news that change the value or the fundamental value of a company. And when people hear that the U.S. government is going to purchase 100,000 cruise missiles from Raytheon at $25,000 or $30,000 a missile, Raytheon's going to go up. Now, we're not going to talk too much about the unlock period because that's a more complex scenario, but it's also a very powerful one. The other one is the FDA. When the Food and Drug Administration makes a decision to either approve or deny a pharmaceutical, that can send the company skyrocketing. And if you watch the ticker, you can get a good idea of when they're going to come out with their results. Now, if you wait till the announcement, you're oftentimes going to miss the move. But we just got, and I'm going to show you the trade. Gilead had its stage 3 medication to treat systemic fibrosis, and I can't be any more specific than that because I don't know the illness very carefully, or, in great depth. But a major medication of theirs did not meet its therapeutic endpoints. It had a slightly better safety profile, but it had no efficacy, and that crossed the wire. And crossed the wire at a great time for options traders. It crossed the wire after stock trading closed and even after hours trading. So nobody could move the stock on this news. So I recommended to go in that night and place a put on Gilead at 31 cents. In the morning, it hit, and 30 minutes later, I recommended to sell it at 61 cents. We were out at 61 cents. We made just under 100% in a half an hour on the bearish news that Gilead had lost this pharmaceutical via an FDA denial. Now, number 7 is the old basket of stocks. And this is the thing that a lot of people recommend that you do. And I just threw it in here because I didn't want to put it on one slide. But this is another options trader killer. And you'll see advertisements like this all over the internet. The 10 best stocks to trade options, the 10 stocks that you should watch to trade options. Create a basket of stocks to create options, because that's going to give you the best options trading opportunities. The fact of the matter is, if you create a basket of stocks and narrow your window and your scope, that's going to be an options trader's killer. You don't want to ever create a basket of stocks. You want to look at everything, because you want to look for major fundamental changes in any stock. The ones that have the greatest reward, which are the small cap and the mid caps, carry the biggest risk. Well, we're going to talk about risk reward in a second, but these components are very, very important to know. And these are what make options traders money. And if you consistently follow the roadmap that these components lay out, you're going to turn your trading around. And I'm going to show you how to create a watch list and show you how to create a trigger so that the stock comes off your watch list and you enter an options trade. Now, these are the things you have to avoid doing, because more often than not, they're going to lead to losers. Now, creating an options position on a beaten down stock, anticipating a trend reversal, that is a losing proposition. You don't want to anticipate a reversal in trend. If the stock falls for a good reason, just because brokers tell you it's now at, quote, fair value, unless they upgrade it, unless you see some clear-cut change in fundamental analysis, i.e. the parameters that I mentioned previously, you are going to avoid this stock at all costs. The other is creating an options position on a stock with a tarnished brand. And I can think of two right off the top of my head. One is Mylan Labs. Remember what happened with EpiPen. They really got crushed on that EpiPen deal. They raised the money. Congress went after them. They wound up settling the whole thing for, to them, a relatively small amount of money. I think a $500 million fine. But we have to look at Mylan Labs as a dead stock, and we don't want to create an options position on Mylan. The other one is Chipotle. They had E. coli in their meat, and Chipotle fell an enormous amount of points, came way, way down. Now, Chipotle and Mylan are damaged, tarnished brands, and we do not want to touch them. Remember, we're creating positions in a time-sensitive instrument. So we don't want this weighing on our shoulders. And remember, the fact that Mylan has this bad press, that's a component of its fundamental analysis. The fact that Chipotle came out with E. coli in their meat, that's a component that must be factored into their fundamental analysis. So we stay away from these. The third is creating an options position that isn't liquid. And it's very easy to avoid. You just have to be aware of it. If the option has small open interest and small volume like ETFs, you just don't want to place a position there. It's going to be hard to get in, and it's going to be hard to get out. And the difference between the bid and ask is going to be very, very big. So you're going to have to give up money going in, and you're going to have to give up money going out. And you don't have to do that with most positions. So don't take this knock against you right at the start. Walk around these red lights, and let's go with the stocks that really have a great chance of flying without these weights on their shoulders. Now, I'm going to show you some trades that we actually took. These are trades that we took in the options alert portfolio. Now, this is Oclaro, and it is an optical networking company. Now, I didn't know anything about it except I watched the ticker. And right here, right around November 3rd, I saw 10,000 calls cross at the November 18 November, this is the monthly, which is today, at the $9 strike. And I entered right here. This is where I recommended it. Now, it went up and then came back down. But then somebody bought another 10,000 calls, and the stock shot up. And then it began to drift down again. And somebody just recently put in another 908 calls, and now they're rolling forward to the December monthly at the $10 strike. We're currently up 165%. And the only reason is because this is a marker of fundamental analysis. When people see this and other people track it, they're seeing that traders are, and Oclaro is a small cap. It's only a $7 or $8 or $9 stock. The investors here can easily take a position in the stock as opposed to a position in options. But they know something, and it doesn't make any difference what they know, but they're willing to risk an enormous amount of money. Right here, we have about 22,000 calls committed to this stock. And we're in it, and it's a gigantic winner. This, to me, is a change in fundamental analysis, and this is a key to trading options successfully. And this guarantees that, see, this retracement, it will not continue, because investors keep pounding the table, and they're not buying retracements. They're chasing this up. And they're continuing to buy calls. And I believe today, I didn't have a chance to look today, but I believe that there were more crossing today, although I didn't have a good chance to look. They're still pounding the table on Oclaro. And here's another position that we took Home Depot. And you can see this, what I did was I pulled a lot of the recent trades. Now remember I said we don't take a trend reversal? Home Depot had stellar earnings and stellar forward guidance. And when I saw Home Depot fall, I said, I just don't understand why the stock is coming down on a really, really great earnings report and great forward guidance. But I was not going to be the guy to call the trend reversal. I was not going to be the guy to say, okay, Home Depot's now trading at a premium. I wait for the big boys to tell me that. Well, right here on November 16, 5,400 calls crossed at the monthly strike price of 124. And we went in on the December 16, 125s. We closed the position 36 hours later, up 90%. And this was the only trigger for me, was that somebody bought a pullback and made a decision in a very, very big way that this stock was going to resume the uptrend. And man, it did. I don't know what Home Depot did today, but the first day we bought it, it went up $1, and the second day we bought it, it was up over $3. It's a $4 move in 48 hours, and it just shot this, the price of the options up. Now here's Gilead. It's the stock that I mentioned to you. Now phase 3 trials failed on the medication that had about 27 syllables. And it was a phase 3 trial for a treatment to treat a systemic fibrosis type of illness. And it really was released overnight, and you can see the gap down here. And the thing was, I thought we would never get into the option because the stock would open and the price of the put would skyrocket. And I always recommend in the alert newsletter to buy a put or a call or a spread at a limit order, not just at the market. I place the order at night and put it out, and I always take all the trades I recommend for a $75 put at 31 cents. It was executed at the open, and we sold it 1 hour later for 61 cents. Just under 100% in about 30 to 40 minutes, all based on those key parameters that I reviewed with you in earlier slides. Now, while other people are studying the Greeks, and while they're studying complex option configurations, we are making money. Here's another trade. Now, unfortunately, this tag is overlying the ticker, but this is Carnival Cruise Lines. What's the news? They got exclusive rights to cruise to Cuba. When President Obama opened relations with Cuba, Carnival Cruise Lines got the only right of all the cruise lines to go to Cuba. Well, that's enough news for me. It doesn't even make any difference whether ultimately it leads to more money to the bottom line. When people hear that, I know they're going to pound the table on Carnival Cruise Lines. On that, we want to be the first ones in, and we were. And what I did was I configured a bull put spread. I hedged the position a little bit because this really wasn't a clear-cut driver in revenue. It was just news that may not lead to any increase in revenue. But it expired worthless when we got 100% of our net credit, simply by understanding that this company is receiving exclusive rights to Cuba was important. And this information crosses the same ticker or tickers that I look at when I evaluate companies for options trades. Now here's another, and this is Facebook. And this is one of our losers. I rarely trade earnings. But I really believe that Facebook is just one of the stocks that if you own is a stock that you buy and hold forever, that you're never going to give up, because it's basically wrapping its tentacles around every facet of American society. Well, they came out with stellar earnings, but Their forward guidance for 2017 was very muted. And it's really advantageous for companies to mute their forward guidance because this is a very litigious society. If you look at GoPro and you look at Fitbit and you look at the companies that have fallen considerably, they're all under investigation by multiple legal firms for manipulating their investors, for not letting them in on the risk. In other words, their forward guidance was not quite clear. So companies are very, very circumspect about the kind of forward guidance they announce. If they don't, I mean, if Facebook fell 50 points, there would be 35 law firms involved. But as long as their forward guidance is very, very toned down, and then they overperform, they do well. Well, their forward guidance was very muted. The stock fell, and the butterfly instantaneously became worthless. Now, I want to ask you a question in your own mind here. Now, here's the position that I created. And understanding how to create a butterfly is very, very simple. And like I said, this is at the end of your training in any mentorship program. You're going to learn how to create a butterfly in a very, very, very simple. I bought a 130 call. I sold 2 140 calls, and I bought a 150 call. My net debit was $2.70. And this is what's important in this butterfly. It cost me $270 per butterfly, which is my maximal loss, but my maximal profit was $730 per spread. Now, it limited my upside, but it still gave me a nice upside. But I'm going to ask you another question, and I hope that you answer this correctly, although few people do. And that is, when you trade options, what is the most important thing that you have to look out for when you trade? I mean, what is your goal when you trade options? And here's my question. What's the #1 goal in options investing? Now, I know that most of you are going to say making money, but you're not going to believe it. But making money is not the #1 goal. This is the #1 goal. It's capital preservation. You don't want to risk a lot of money on risky positions. That is the sole purpose of creating a spread position. That's, in my opinion, what spreads were created for. They were created to provide you with the ability to trade options and create riskier positions and mitigate your losses by capping the amount of money you could potentially make. If the spread doesn't do that for you, then it's not providing you, I believe, the function it was created for. Each individual option on Facebook is $500 or $600. The spread gave me the ability to leverage a single position at $270 and still make $730. So I was protecting my capital here. And that's my #1 priority when I trade options. Now, once you decide that you want to preserve your capital with a spread, it's really a matter of style, what spread you want to use. I used a butterfly, but you may want to use a vertical spread. There's no right or wrong to it. The biggest decision to make is, I want to create a spread. I want to hedge my position. If I'm right, I still want to be able to make decent money. For every buck that I put down, I want to at least be able to make 2, potentially 3. But at the same time, I don't want to have to put up this enormous amount of money to take a position in earnings. That was my strategy for creating that butterfly. And it was good that I did, because even though Facebook beat earnings, the butterfly, the next day when all the volatility leaked out and the fact that Facebook was down 10 points was worth about 2 cents. And it's expiring today absolutely worthless. It was worth so little after Facebook fell that it would have cost me more for commissions than it would have cost me to buy it back. So I'm letting it expire worthless. Now it's also so that's why you create spread positions. And what spread position, as I said, is really a matter of style. And in a mentorship program, we go over really for a considerable period of time, creating spread positions to hedge risky positions. It allows you to trade slightly greater, it allows you to assume greater risk. The other thing that's extremely important is for you to make an accurate assessment of risk so that you can position size. Now, if you perceive something as being fundamentally very safe, you can allocate more money, because part of capital preservation is also leveraging a safe position and trying to make more money. These are all key to becoming a successful options trader. Now, sometimes you're going to be wrong. Sometimes a position that you perceive to be very safe is going to collapse on you. But if it does it only rarely, ultimately you're still going to wind up being a successful trader. Remember, the most perfect options entry, taken with the best fundamental analysis, with ancillary technical analysis that you perceive to be very safe, once in a blue moon will collapse. It doesn't make any difference. You're not looking at any given position. You're looking at your overall track record. So the 5 core principles of a successful options trader is number 1. And this is what everybody worries about up front. Don't worry about the Greeks. They're easy to learn, and their application to actual trading is really very minimal. Remember, the ultimate result of all the Greeks is the price of the option. So you see the result. Now, the only Greek that I look at is the delta. If I want to put in an order to sell the position, I want to get an idea of how far the stock has to move, if it's a long position, to upside resistance before it's going to butt up against something and may turn around. And in order to do that, I have to look at the delta to see what the option would be worth at that particular time. But let me tell you, I don't even use the delta very much. And also, don't worry about the mechanics of option spreads. They're easy to learn and easy to apply to trading. The only thing that's really key is deciding that the specific position has enough risk that it makes you want to create a spread. Once you create a spread, I'm telling you, after a little bit of practice, you're going to be creating them quite easily, because you can learn the mechanics and options for dummy, and the applications in a mentorship program are really quite simple. Once you've done it 5 or 6 or 7 times, they're going to come to you like shots in the dark. Very easy. And you know what's going to happen? You're going to develop your own style, your own way of mitigating risk. You may like a butterfly, you may like an iron condor, you may like a vertical. You go with what you're comfortable with. The important thing is that your spread position, which will always cap your earnings, is going to limit your downside. And remember how important capital preservation is. And learn how to monitor those key stock catalysts. And here's the thing, some of the stock catalysts will place the stock and the option strike and month on a watch list. You have to learn when to pull the trigger on the trade. And I need Rory to bring in my watch list, because I'm going to show you some of the stocks on my watch list, and I'm going to tell you what I pulled the trigger on this morning, and we're not in it yet, but the position is there. So you would learn how to create a watch list. Now, the watch list is going to consist of those stocks that had those key stock catalysts, none of the downside weights, like a tarnished brand. Nothing that's going to weigh that stock down. It's just ripe there to take. And for one reason or another, you don't want to pull the trigger. Now, when you put stocks on a watch list, occasionally they're going to run away from you. And that happens to me all the time. But I don't care. Because when you trade with specificity, some trades are going to run away. But when you get into a trade, the likelihood of getting a winner is extremely high. So you have to learn the science of capital preservation, which is the key to profitability, and assess risk on each trade. Give it a 1 to 5, and then allocate your capital accordingly. It's important for you to do it, not just in your head, but in a very clear-cut way on your risk list. If you make a decision that you want to trade earnings, I don't think there's anything wrong with it, as long as you understand that you're taking a very risky trade. You're going to allocate a small amount of money, and you're going to do it with an appropriately configured spread. If you monitor these, if you master these things, you are going to make money. Now, these are the stocks, I put them on my watch list, and this is the one I pulled, the trigger I pulled today was JetBlue. This is one of the stocks on my watch list, and the reason, call volume has been extremely heavy, and Warren Buffett has created heavy investments in the airline sector. That's enough for me. And one thing I did not mention, I failed to mention, was a big name investor. We placed a position recently, it was about a year ago, when Carl Icahn went in and bought 15% of Cheniere Energy. Now, Cheniere Energy was really a dog of a stock, but just him going in gave that stock a bump, and we bought a spread on it, and we just barely squeaked out with 100% of our net equity. It went up on his participation in the company alone. So those things changed the fundamental analysis of a stock. It changed investors' perception of its value. The stock went up. We jumped into Cheniere, and we got a 100% of our net equity on the spread. But JetBlue is on my watch list for this reason. I didn't want to pull the trigger to today, and the reason I pulled the trigger today is another large position crossed the ticker. And I will tell you exactly what it was, and I'll tell you when it crossed. Hold on a second here. Where is it? I'm sorry, it's another stock. Now, Freeport-McMoRan Inc., FCX, is a stock I had on my watch list that ran right through me. It's a natural resources company that participates heavily in infrastructure, in the creation of infrastructure. When Trump was elected, it was on my watch list. When Trump got elected, this stock launched into a rocket ship. Now I'm waiting to pull back, and I'm still looking to buy calls, because Trump hasn't even allocated any money to infrastructure, but I believe he's going to do it. And stocks like Freeport-McMoRan are going to benefit greatly. Now, the stock I may pull the trigger on Monday is PayPal. And PayPal was the people have been pounding the table on that. And today, at 1:07 p.m., somebody bought 3,148 calls at the December 16th expiration, at the monthly December expiration at a $43 strike. Now that's, I think, the fourth large call purchase made on PayPal. So the PayPal volume is extremely heavy. And we're going to get into PayPal. And I'll probably pull the trigger on PayPal on Monday. Now the other one that's on my watch list is the Russell 2000 Index. The ETF is IWM. and I was looking at the January 7, 1350, 1450 bull call spread. That's a $14 a spread. Maximum profit is 36 bucks. Now, this is simply based on everything else that I told you at the beginning about how bullish a take I have on the market. Now, this is a very, very risky trade because it's not moving up on any specific, unique trigger like it is with Qualcomm and these pinpoint call purchases. JetBlue, pinpoint call purchases. Those are the strongest. Or the demise of a phase 3 drug trial. Those are the biggest movers. So I have to be careful, and that's why the position is hedged. And on these, we're just going to buy puts or we're just going to buy calls. On the index, we're going to buy a spread. Now, here's some of my 216 close positions. In 216, early on, I was not really sure if the market was going to follow through. So most of my positions are spread positions. On Relapsa, 100% net credit. On Delta Airlines, I bought a call, 50%. Perigo, 100% net credit. Relapsa again, 100% net credit. Bluebird Biomedical, 100% net credit. Here's Raytheon, 209%. Micron, 100% net credit. Rio Tinto, 100%. Chicago Bridge and Iron, 100%. Marriott Hotels, 100%. Rio Tinto again, 100%. PayPal, 100%. Holix, a call, 50%. I lost on Smith & Wesson. It was a spread. I lost on a gold put. I sold it at 75%. I bought it back then, lost 83%. Optokinetics, 112%. JetBlue, 50%. GoPro, 100% net credit. Estee Lauder, 100% net credit. Again, Delta, 100% net credit. This is Newmont Mining, 100% net credit. This is Western Digital, 100% net credit. Carnival Cruise Lines, 100%. U.S. Steel, 100% net credit. This is Allergan, 100% net credit. Anadarko Petroleum, 100% net credit. Oasis Petroleum, 100% net credit. I'm very aggressive. I create a lot of positions, and I leave it to you as the investor to asset allocate across multiple sectors. So instead of getting 2 or 3 or 4 positions at any given time in the portfolio, I may give you 10, 11, or 12 because I want you to take multiple smaller positions. And what I try to do in any given month is create positions across sectors. What I do is I look for positions in overlying stocks to create options positions in underlying options positions in different sectors to give us diversity. But we could have as many as a dozen open positions at any given time, but they hit like bullets because I'm basing them on all of the metrics that I showed you here today. Now, I want to go into a little bit of the cost of our newsletter, and it's really pretty cheap. Now, the 1-month Options Alert newsletter is $79. It comes with a 15-day money-back guarantee. You just don't want people to ask for their money back on the we've had people who ask for their money back on the 29th day and then buy it with a different email address, again, for a month. So it's a 15-day money-back guarantee. The 3-month and the 1 year are 30-day, no question asked money-back guarantee. If you don't like the newsletter and you're on the 3-month or the 1 year, you just tell us you don't like it and we'll refund your money. No questions asked. If you're not happy with it, we don't want your money. We don't want to keep anything. Now, here's what you get. You get your flash alerts. Now, we don't have those yet formatted for SMS to go to your text. Unfortunately, they go to email. But if you have the email on your cell, you're in a position to take the trades. And 90% of my trades I put in at night. Some of the sell orders, when something really pops on a sell order, is when you may get something you want to devote your attention to immediately. And then I do a monthly review and a weekly update. I always go through all of our positions on a weekly and a monthly basis to make sure that you understand my take on where we are. If a position is in the negative, and listen, we do take losers. I'm not going to sit here and pontificate about how we never take any losing trades, because we do take losers. But if we asset allocate appropriately, and we get 85% or more of our trades as winners, we're going to make it a lot of money. So we do a monthly review and we do a weekly update, and we look at all of our positions, all the news that came out, all of the support and resistance levels, everything that we need to make a decision as to whether or not we're going to hold the position or we're going to dump the position. And again, it's 100% guaranteed. If you don't like it in those 30 days, you just let us know, and that's the end of it. Now, the other thing is we have an options mastery program, and it's a 14-hour weekend-long intensive course. And we take a maximum of 4 students per class, and it's 7 hours on Saturday and 7 hours on Sunday. So it's the kind of weekend where you're really going to get a migraine headache, and you got to keep some Motrin right at your right on the desk and a lot of bottled water. But during this time, I teach you everything. I teach you how to create a watch list. I mean, I really run you through everything. I mean, I don't have to read these bullets. But the other thing that I do with you is I'm going to stand over your shoulder and watch you create options positions that you're going to share and discuss with the class. The nice thing about options is that you can really nicely create positions when the market's closed, because options don't trade continuously anyway. And most of the positions that I look at, I look at night, and that's when the options newsletter goes out. So if when we take the class on a weekend, we can go through a lot of options positions. I'm going to show you my watch list, and you're going to tell me whether or not you want to buy a call, buy a put, where you want to buy the position, at what level, based on where the other investors are going in, and whether you want to create a spread and what kind of spread. By the time you're done, you're going to know exactly what you need to do when you want to pull the trigger on an option, whether you want to buy a call, whether you want to buy a put, or whether you want to hedge it with a spread. And I'm going to give you really a lot of key secrets. Now, I've talked extensively about a ticker, but it's really a series of tickers, and they're very inexpensive. And that's what I'm going to show you in the Options Mastery Program. How do you monitor all the large put and call positions? Not every put and call position, but the big ones. How do you monitor the upgrades and downgrades? How do you monitor the FDA decisions to approve or deny a medication? How do you do all that and do it easily in, say, 20 to 25 minutes an evening? I'm going to show you how to do that. And from there, you're going to look at the positions in your watch list, decide whether they warrant staying or whether you're going to move them off and bring others on. You're never going to have a watch list more than a dozen positions long. Then it becomes too complicated, and you just start losing track of everything. And it's a totally unique educational experience, because what you spend an enormous amount of time on with other mentors, which are the Greeks, and creating complex spread positions, are what we are going to really play down. Because like I told you, those are not really the key to becoming a profitable options trader. Now, the Mastery Program is $14.99, and it's normally $2,000, and it's really relatively cheap, considering I have people come to me who've spent $4,000 and $5,000 for a mentorship program, and they lose $75,000 afterwards. So it's really very, very reasonable. But when you're done, I can promise you that you should be able to trade as well as I do, because you're going to have all the information that I have at my command, and it's going to be really easy for you. So the last slide I was going to show you, you're all going to get an email regarding the prices, and we're at www.rightlinetrading.com, info@rightlinetrading.com, and here's our number, 855-765-6681. and you're going to ask for Rory. And then I'm just going to now go in and ask any question. What I wanted to do was finish so that if people don't want to be plagued by other people's questions, they don't have to stay. That's why I like to finish the presentation and then go to questions. But usually I think the questions are really, really good, and really you learn a lot from them. They always teach me stuff. Okay, well, really very few questions. Okay. All right, well, listen, that's the program. Rory will be sending you an email soon, and I really hope that you'll come on board in one way or another. I didn't cherry pick the trades out of the portfolio. I simply cut and pasted the first 2/3 of the 2016 year, and that's all I put into the slides. That's it. And like I said, we do take losers, but the vast majority of our trades are winners. And we're closing out a spread position today on Apple, 100% net credit. We're closing out a position today on an energy company, and the name, and I just cannot remember, but that's going to be 100% of our net credit. We're going to get a partial credit. The one loser we have is GoPro. I mean, that's going to cost us a little bit of money. We're going to get a partial credit on Pandora, and we also are going to get a 100% of our net credit on a spread I took on the S&P 500. And right now we have an enormously profitable spread on a short position I took on the U.S. dollar versus the European currencies. So when the dollar goes up and the value of the European currencies go down, this position goes down. And the dollar's been skyrocketing, and the value of the European currencies has been falling like a stone. And we are way, way profitable on this position. It's a spread position, and we're now it's a bullish spread position, and we are just now almost at 100% profit. So that's going to close out as well. So we're going to ring the register today on options expiration day. So if you have any questions, let me know. This is really our core methodology, and I've really given you a lot of information. I didn't want to make this just a slide presentation where you don't really learn anything new, but you really have the nuts and bolts of how we do it. I'm simply going to fill it in, all the texture and content in the mentorship program, or if you want to take my trades, just come along with the Options Alert newsletter. The letters are all guaranteed. So listen, everyone, have a really wonderful afternoon. Take care. No matter what you do, I really wish you really a profitable investing career, and just really a lot of health and happiness. So everybody take care and have a really, really great weekend. Bye-bye.